In this video, I'm gonna showcase a new FVG indicator that can be used in two strategies. One, we can use it to trade within bullish and bearish trends. Number two, we can also use it to trade based on trend reversals. If you happen to find value in this video, remember to leave a like. Let's get into it. Now, to get started with this indicator, you want to go to TradingView and then open any trading security that you like in any time frame, and then click on Indicators and type in Breakaway Fair Value Gaps. And it's gonna be this one by Lux Algo. Now, you may be thinking, but what exactly is this indicator? Well, the Breakaway Fair Value Gap indicator by Lux Algo identifies and visualizes specific fair value gaps that happen within points where the price breaks new highs or lows in the market. Now, here's an in-depth breakdown of this indicator and its usage. First of all, what is a fair value gap or an FVG? Well, an FVG is the price gap left on the chart where no trades occurred due to strong directional movement indicating an imbalance in the market. This is a bullish FVG and this is a bearish FVG. Now, a breakaway FVG occurs when the price creates an FVG while at the same time breaking a new high or a new low within the recent trading range, signifying strong momentum from buyers or sellers. Now, I know you may be thinking, but why is a breakaway FVG important? Well, first of all, it represents a heightened market activity where the market is either overextended or imbalanced. Traders can use these gaps to predict potential price movements, such as continuation in the direction of the break or reversals to rebalance the gap. This indicator is made up of the following components. First of all, this is a bullish FVG, and under the FVG, you can see a line called a mitigation level. Mitigation levels happening within bullish fair value gaps are called bullish mitigation levels, and for a bearish FVG, we have a bearish mitigation level. Now, a mitigation level is basically the point where the price would need to come back in order to mitigate a specific FVG. For example, for a bullish FVG like this one, in order for it to be mitigated by the price, it would need to come all the way back down and go under this line, and vice versa for a bearish FVG. And then we have this table which basically gives you the statistics of the FVGs. First of all, we have the bar analysis length, which can be seen under the max bars value. As you can see, we have a default of 60 bars, which means the indicator is going to be analyzing the past 60 candles to identify bullish and bearish FVGs. It tracks bullish and bearish FVGs that happened within those 60 candles. Now, on this table, we have the max bars setting, which has a default value of 60, which is the bar analysis length, indicating how far back the indicator went to track bullish and bearish FVGs. It tracks how many of these FVGs were mitigated by the price. As mentioned before, mitigation is when the price comes back to the initiation point of an FVG, making it invalid. Now, here we can see that over the last 60 candles, this is the percentage of bullish FVGs that were mitigated by the price, and this is the percentage of bearish FVGs that were mitigated by the price. And then we have the average bars before mitigation. This shows on average how many candles it takes before an FVG is mitigated by the price. Now, for bullish FVGs, it usually takes around this number of candles. Now, for bearish FVGs, it's usually around this number of candles. Now, this information is important because, for example, if you're trading within a bullish trend and trading based on trend reversals, a high mitigation percentage suggests that the price is likely to come down and mitigate more FVGs, helping your trades hit their profit targets. Now, in the indicator settings, we have the trend length, which determines the lookback period for identifying breakaway FVGs. There is a toggle to show mitigation levels, and then you can also change the maximum duration, which is the maximum number of candles the indicator uses to track FVGs. You can also change the style or the colors of the FVGs and adjust the dashboard settings. After making your changes, click OK. For me, I'm gonna stick with the default values. Now, the first strategy that we can use this indicator to trade is based on trend continuations. If you have a trend indicator like a 100 length EMA, the conditions for a long trade are going to be straightforward. Condition number 1, ensure the price is trading above the 100 period EMA. Condition number 2, you want to wait for the price to return to the most recent FVG by touching its mitigation level. This is a retracement. Now, after the retracement, you want to look for a bullish engulfing candle. This is our engulfing candle. Now, at the time the engulfing candle forms, you want to check the table to ensure the bullish FVG mitigation percentage is at least 70%. If it's above 70%, that would validate the entry. Enter a long position, set your stop loss under the most recent swing low, and then for the take profit, it's going to be at 1.5 times the risk, letting the trade run. And as you can see, it was profitable. Now, for a short position, you just do the opposite. Now, the second strategy is trading based on trend reversals. Mitigation levels can act as targets for these reversal entries. If the price is below the 100 period EMA, indicating a strong downtrend, you want to be looking for signs of a bullish trend reversal. We can use an indicator like the Smooth Price Oscillator by Big Beluga, which prints reversal dots and shows overbought and oversold conditions in the market. In a bearish trend, if the market is oversold and then the oscillator signals a possible reversal by printing a dot like this, we then check the table to ensure the bearish FVG mitigation percentage is at least 70%. In this example, it's above the 70% limit, indicating a high likelihood that the price will go up and mitigate a bearish FVG. If we enter a long position, set the take profit at one of the bearish FVG levels. It could be the first one, the second one, or even the third one. The stop loss would be under the most recent swing low, letting the trade run, and it was profitable. These numbers here actually indicate how many candles have passed since an FVG was mitigated by the price, helping you to track their relevance. Ladies and gentlemen, there you have it, a simple FVG indicator that allows trading based on two strategies. If you want to check it out, you can find it on TradingView. That's been it for this video. I really hope you found some value. If you did, remember to leave a like or even consider subscribing to stay tuned. Thanks for watching. See you next time.